Hello everyone, this is Andrew McNair from Swan Capital with our October 2022 Swan Report. In this month's video, we're going to discuss some recent headlines that influence the financial markets. But I also want to provide you some perspective on what these developments may mean for you over the next few months ahead as an investor. But please stay tuned at the end of this video for some required disclosure statements. Now remember that this is not personal financial advice to you. And how could it be? It's going to be viewed by a lot of people. But if you have questions about your personal financial situation, stay tuned at the end of this video so I can tell you about that opportunity. Now, at Swan Capital, our market outlook remains cautious, and it has been for most of the year because of inflation and rising interest rates. The third quarter of 2022 was a roller coaster for markets. After hitting yearly lows in mid-June, markets rallied in July and into the first half of August, giving us hope that it was over. The catalyst for the mid-quarter rally, a mostly flawed notion on markets' part that the Federal Reserve would pull back from its aggressive stance and make a pivot on rising interest rates and continuing to raise them to combat inflation. Well, the market was wrong, and now we have slid back from that rally. However, the market is starting this fourth quarter by sliding downward yet again as increasing interest rates to fight inflation remain the Fed's priority. Although we've seen a decline in the rate of inflation since June, inflation remains stubbornly high. One reason it has come down since early summer is because oil has declined from $120 per barrel to just $86 per barrel, which really gives us room around the collar because the drop in oil prices is good news for consumers, but other staples, including groceries, are continuing to rise. Now, some decline in the price of oil is natural at the end of summer as people end their vacations and they start sticking around at home more. However, oil is a notoriously volatile commodity and changes all the time, and its prices can shift upward at any time. GDP, we need to keep a close eye on that. GDP stands for gross domestic product, and those numbers for the second quarter were better than the first quarter, but still dropped by 0.6%. Now, while GDP results for the third quarter won't be released until late October, the current expectations is for GDP to remain flat. Economically speaking, the U.S. has not experienced any growth this year, which is a real issue because we're supposed to have positive GDP because we've been digging ourselves out of a hole since COVID. Despite these negatives, Americans are still spending, and corporate earnings haven't been bad because of consumer spending. However, it could be only a matter of time before consumer spending starts to stall and the Fed's interest rate hikes begin to take a bite into the American consumers' spending habits. Now, the Fed raised rates for 75 basis points for the third time in its September meeting, and it still needs to unwind its massive balance sheet. The Fed's rate now stands at 3.25%. So companies and consumers will face mounting hurdles as debt service becomes more of a difficult thing when it comes to their earnings. When you're spending more for buying a car or you spend more per month for buying a house, these steps might be what it takes to fight against inflation, but they could drive us into a deeper recession and potentially worse. The other major developments this month is when you look at other countries' monetary policies. For example, the Bank of England announced it would suspend its quantitative tightening scheme, which is basically rate hiking to support the falling pound against the US dollar. On the surface, the explanation really didn't make any sense. Why signal that you aren't going to raise rates further when you're already behind the curve and behind the United States? The United States continues to raise its rate faster than other foreign countries. Now, as we continue to tighten interest rates, our dollar continues to escalate in value. So why would you buy a British bond called a gilt if you can get a better yield here in the United States? The BOE, or the Bank of England official bank, is actually currently at 2.25%. This is the version of their funds rate. But what a difference a day made. Shortly after that announcement, it was brought to light that the British pension funds had expressed distress that their bond holdings would be severely devalued if the BOE continued to tighten. This information made much more sense. As you can imagine, the same old concerns of a global economic slowdown has returned and markets reversed their gains from the day before. We're keeping a close eye over in Europe as, again, monetary policy with the euro and the British pound, again, fight for supremacy against the United States, which continues to rise. Now, on another note, Apple was downgraded by Bank of America. A rare move given that Apple has always been the go-to for investors as a company that can do no wrong, that has a perfect track record. But Apple has long been viewed as an aristocrat among stocks. This may be the last shoe to drop for the market downturn. After Apple gets hammered, what else will be left? To be fair, Apple has been smacked around price-wise, dropping significantly from $180 a share to $140 a share, yet a lot of what was trading in news has chipped away from the periphery. But this time is different. Apple has actually said it's paring back producing for the new Apple iPhone 14 after failing to see a high demand as anticipated. Now, this is really monumental if you think about it, because each new iPhone for over a decade has been greeted with immense excitement, with people sleeping outside of stores to be the first to get the newest model and paying increasingly higher prices for these models that offered really few breakthroughs as the original iPhone, of course. It seems people are starting to get sick of paying close to $1,000 for something that may be obsolete in a year. And that is a big deal when consumers are starting to be careful with their spending because of inflation that they're seeing at the grocery store. Since Apple is the largest S&P 500 member by market cap, maybe this is a sign we're close to the bottom with the market, but only time will tell. That's it for this month's Swan Report, and I want to thank you for listening every month. And please remember that nothing we talk about here is personal advice or a recommendation for you. If you do want a 1-hour visit with us, we call that a discovery visit. And it's a 1-hour discovery visit to answer your questions about the economy and about the market and how that affects your personal financial situation to make sure that you are on track financially for retirement. If you want to take us up on this 1-hour complimentary visit, give us a call at 850-380-9558. That's 850-380-9558, and we'd be happy to talk to you. But we look forward to seeing you next month, and have a great month until then.